Okay, let's talk about SMSF.
SMSF, yep, self-managed super funds.
Yeah. So what is it? I mean, what's the hype around it? Well, obviously I know, but I just wanted you to tell.
Well, the great belief about a self-managed super fund is I can do it myself, I control it myself, and I'm sure I can make more money than those retail funds out there who keep on losing money for me. My fund seems to go every year, and they charge extra high fees, don't they?
Yeah, exactly. It just depends on how much money you have. It's on the scale it goes up.
Yes. Self-managed super funds tend to average less than 1% of per annum of your fees, of fees-based calculation, whereas you can have up to some funds charging 4.5% per annum. And that's not only on the asset value, that's on every transaction. So it can get expensive.
Yeah. So if you have any tips for our listeners.
Okay.
So
look into doing a self-managed super fund because they're not as complicated as you would believe. I mean, they can be as simple as you going and opening a term deposit. And who hasn't opened a term deposit? If you can open a term deposit and run that term deposit, you can run your own self-managed super fund with the help of an accountant. It can be that easy.
Okay.
Okay.
But how to manage it, really?
Okay. Well, the self-managed super fund is, in effect, a trust. It has certain accounting requirements that are required by the tax office and ASIC, which is everyone's heard of ASIC, Australian Securities Investment Commission. And also you have tax returns that have to be recorded and record certain information for the different benefits and members. And there's lots of involved calculation, but that is the job of your accountant. So your accountant will look after all the accounting functions and the tax functions and the administration, but you'll look after the investing functions. After all, it is a self-managed super fund.
Okay. So, but some people, they say it's a bit costly to manage self-managed super fund, the auditing and stuff. It's going to be some arguments there. I think that's much more than what the retail fund is going to charge you.
Okay. Well, self-managed super funds tend to have a set cost, mainly, generally. And therefore, unless you've got at least $100,000 to invest, self-managed super funds tend to become expensive. So, yeah, they become expensive. However, it is important to remember that if you have special goals, you can start your self-managed super fund off with $1.
Wow.
Okay. You must have at least $1 in assets for a self-managed super fund to be a valid self-managed super fund. Okay. And then you have to do returns and compliance. But obviously you would want to be building that self-managed super fund up pretty quickly because otherwise the initial set fees would certainly take a while of recovery.
Okay, great. So that's interesting. I mean, you really hit it on the nail because those who know me, my clients, they know that I always told them, let your super fund get to 100,000, then come and talk to me. Because before that, it's really, really not worth it. But of course, again, that's not an advice. No. You need to talk to an advisor. But yeah, especially because, for those who want to buy property through self-managed super fund or use it as a deposit, just tell them, let it reach to 100,000, then we'll have a conversation.
Then you can have a conversation and do marvelous things and control your own life.
Exactly. And meantime, just learn.
And learn.
Yeah, this is the best time you have. Now learn, and then while your money is growing, your super fund is growing, then by the time you start fresh, your self-managed super fund, at least you can really apply those knowledge.
Correct.
To grow.
And Helia, my clients that have self-managed super funds all come back and tell me how easy it is. Why didn't you convince me to do this earlier? Wow. Well, I tried. But there you go. You're doing it now.
Yes. You have to be ready.
You have to be ready. Yes. Exactly. When you're ready, then you're ready.
Yeah, that's
Until
right.
then, you're not.
Yeah. As long as there are so many strategies available to grow your wealth. So, and that's why you need to do tax planning. So many people, they get intimidated when talking to advisors, especially accountants, because they think, they're going to slap you in the hand, you can save enough money, or what you've been doing. That's why they're rather to live in that ignorance rather than go talk to a professional.
Correct.
But what we're just trying to establish here is wealth creation by itself means nothing if you are not doing the wealth protection and the tax planning, because even if you build up money altogether, but if you more than half of it, you give it to the taxman, what's the point of that?
Correct.
Isn't it? So that's why everything goes hands in hand at the same time. The tax issues, wealth creation, and wealth protection, which I believe wealth protection comes before wealth creation, because you don't want to lose what
you build up.
Exactly.
And it's all about efficiency and hand in hand and tax planning, doing things efficiently to get the best result.
Exactly.
And keep it.
Exactly. That's your money. Let's keep it.
Yes.
Wonderful. That's what I really love about our job and our business, because when we see people making money and they're happy, so we are part of that journey. I think that's a different pride.
It's good fun.
It's good fun.
Yeah.
So I have a client, a few of them actually, who send me every year a card to say that because of you, we are in this journey. So and now they've got their health clinics, so more than 8-9 properties in Australia. So yeah,
correct.
It's just over 10 years, that's it. And so everything is possible. It's all about start planning now.
Correct. And a self-managed super fund is a great place to do that, especially with negative gearing property, which is basically asset protected in a super fund, self-managed super fund. So it's a good place to be.
Oh, great. So when we say the asset protection for that, so let's say if somebody is self-managed super fund, they bought the property, and obviously it has to be investment because it cannot be self-residential unless it's a business premises. Is different.
Correct, that's correct, yes.
But on a normal residential property, you can't live in it yourself.
Correct.
So it has to be investment residential property. But let's say the person reaches the retirement age. Once they sell that property, how much do they have to pay capital gains tax?
Well, if they've reached retirement age, they would then put their super fund into what they call retirement. Retirement, and when a super fund's in retirement, the tax payable is a big fat zero.
Wow, that's
so
great.
Any capital gains are free, and so is any income that's earned.
Wow,
that's the benefit of the super fund.
Wow, see, that's great. But what if they have that property outside super fund? Even if you are turning 70 years old and you sell it, you have to pay capital gains tax.
Correct.
Wow.
And there's a little secret with capital gains tax and property that a lot of people don't know about. And it's about that depreciation that they've been claiming along the way. All that has to be added back on when they sell the property. So they all of a sudden get a capital gains tax shock, even if they perceive that they've made a loss sometimes. So that doesn't happen in a self-managed super fund.
Wow. See,
There's
this is
difference.
another benefit of self-managed super fund.
Certainly is.
All right. So then keep planning your tax properly with a good advisor, like Steve.
Yep.
And grow your super fund while you're learning, and then later on you can put it in a good use, and I can help you as well to buy that property.
Correct.
Thank you.
Thank you
so much.
again. Thank you very much.